Imagine this, you've poured your heart and soul into a business idea. It's brilliant, disruptive, potentially world-changing. You're fueled by momentum, chasing growth at any cost. Investors are lining up. The media is buzzing, but 6 months later, it's gone. Just gone. It's a story we hear constantly. Why do so many innovative businesses fail despite seemingly brilliant ideas? The truth is often brutally simple: they were never built on a solid financial foundation. Most startup failures aren't about bad ideas, they are overwhelmingly due to unsustainable business models, specifically failing to consistently generate positive margins. Think of it like this: you can build the most beautiful castle out of sand. But if the tide keeps coming in, it will eventually wash away. Focusing solely on momentum, that intoxicating feeling of rapid growth, can completely mask critical financial realities. It's a dangerous illusion. Let's unpack why this happens and how a seemingly small habit can dramatically change your business trajectory. Let's strip away the jargon and get to the absolute core of what drives a successful business. How does a consistent focus on profit margins directly influence decision-making? It's fundamentally about capital, where it comes from, how it's used, and whether you're actually building wealth or hemorrhaging it. Consider this: your business isn't just an idea. It's a machine designed to generate returns. A business's cognitive framework is fundamentally shaped by its ability to consistently generate a positive return on investment, ROI. Think of it like investing in the stock market. You wouldn't buy shares without understanding the potential for growth and your risk tolerance. Right? Now, low margins force prioritization. Every expense becomes scrutinized, every decision is evaluated based on its impact on profitability. A 1% margin means every dollar earned after covering costs gets reinvested in the business. Conversely, a high margin, say 10%, provides significantly more flexibility. It allows you to experiment with new marketing campaigns, invest in research and development, or even weather unexpected challenges. Low margins force efficiency, high margins allow for calculated risk-taking. Let's illustrate this simply. Imagine you spend $1,000 on advertising. With a 1% margin, that $1,000 generates only $10 in profit, barely enough to cover your next small expense. But with a 10% margin, that same $1,000 generates $100 in profit, giving you the breathing room to scale and grow. Okay, let's dive into a concrete example, a simulation designed to show you exactly how this works. We're going to look at an online coaching business, starting with an initial investment of $10,000. This isn't about predicting the future, it's about understanding the power of consistent margin management. Over 3 years, we'll track 2 scenarios, Scenario A and Scenario B. Scenario A will consistently achieve a 20% profit margin on client fees. Let's say you charge $500 per coaching session and your costs are $400, giving you a $100 profit per session. You reinvest that $100 every year, totaling $4,000 annually. Scenario B will achieve a more modest 5% profit margin, again, charging $500 and having $400 in costs, but only generating $25 in profit per session, reinvesting just $500 annually. Now, we're deliberately excluding external factors like market trends or competitor actions. This is purely a test of the impact of your margin rate. Let's build a table to visualize this over 3 years. Pause briefly. The key isn't about maximizing profits immediately. It's about understanding how consistently reinvesting that profit, building capital, will shape your business's trajectory. We'll track revenue, expenses, profit, and cumulative capital reinvested for each scenario. Let's assume a consistent annual revenue of $20,000 for both scenarios, representing 10 clients at $2,000 per year. Scenario A, Year 1, revenue, $20,000, profit, $4,000, cumulative capital reinvested, $4,000. Year 2, revenue, $40,000, profit, $8,000. Cumulative capital reinvested, $12,000. Year 3, revenue, $60,000, profit, $12,000, cumulative capital reinvested, $24,000. Scenario B, Year 1, revenue, $20,000, profit, $500, cumulative capital reinvested, $500. Year 2, revenue, $40,000, profit, $1,000. Cumulative capital reinvested, $1,500. Year 3, revenue, $60,000, profit, $3,000, cumulative capital reinvested, $4,500. Notice the dramatic difference. The consistent reinvestment of $4,000 in Scenario A leads to a significantly larger cumulative capital base compared to the meager $4,500 from Scenario B. Now, let's be honest, relentlessly focusing on margin isn't perfect. It can create a systemic trap. And we need to understand its limitations. An obsession with margins can stifle innovation and long-term growth. While necessary for survival, consistently prioritizing low margins prevents a business from taking calculated risks to scale, delaying expansion or investing in disruptive technologies. This isn't about being cheap, it's about strategically building your financial foundation. Think of it like this: you wouldn't build a skyscraper on a shaky foundation, would you? The trade-off is the potential for exponential growth versus guaranteed stability. Let's look at a graph illustrating this relationship between margin and growth rate. Pause briefly, you'll see that high-margin businesses often have lower growth rates. They're focused on efficiency, not expansion. Conversely, low-margin businesses can achieve higher growth rates because they have more capital to invest in aggressive strategies. Furthermore, momentum, the feeling of rapid growth, is often built after establishing a solid financial foundation. Trying to force momentum without that base is like trying to push a boulder uphill without any leverage. It's exhausting and ultimately unsustainable. The key isn't just about maximizing profit. It's about understanding the rate at which you are building capital, allowing for informed decisions about growth, investment, and risk. So, what's the single most important habit a business owner should cultivate? It's not chasing momentum, it's far more fundamental. Instead of focusing on rapid expansion, entrepreneurs must develop a deeply ingrained discipline of meticulously tracking and managing their profit margins. This isn't about maximizing profits at all costs, it's about understanding the rate at which they are building capital, allowing for informed decisions about growth, investment, and risk. Remember our simulation scenario: a consistently generated $24,000 in cumulative capital reinvested over 3 years, while scenario B barely reached $5,000. That difference isn't just numbers, it represents the potential for significant future opportunities. Prioritize consistently generating a positive return on every dollar invested. This is not about maximizing profit. It's about ensuring your business can sustain itself and fuel future opportunities. We hope this has given you a new perspective, one that moves beyond the hype of growth at all costs and focuses on the foundational importance of building a financially resilient business. Now, go track those margins.